Have you ever wondered why the gold price changes? It's a question that has puzzled many. Gold, a precious metal that has been valued by civilizations for thousands of years, isn't just a shiny object that we adore. Its price is a complex interplay of various factors that goes beyond the basic economics of supply and demand. Today, we're delving into the top 10 factors that influence gold prices. We'll explore everything from mining costs and jewelry demand to government policies and market speculation. We'll even touch on how global events and macroeconomic trends can create ripples in the gold market. So, whether you're an investor seeking insights or just a curious mind, this discussion promises to be enlightening. Stay tuned to learn more about these fascinating factors. First on our list is mining costs. It's important to understand that the extraction of gold from the earth is not a simple task. It involves significant labor and energy expenditures, making it a costly process. Think of it this way. The more difficult and expensive it is to mine gold, the higher the costs that need to be recouped once it hits the market. Labor costs play a big role here. If miners demand higher wages or if there are fewer miners available, the cost of mining increases. Energy costs also weigh heavily. Mining operations require a lot of power, and if energy prices rise, so does the cost of mining. These costs are ultimately passed on to the buyer in the form of higher gold prices. So, as mining becomes more expensive, it can put upward pressure on gold prices. Next, let's discuss the impact of jewelry and industrial demand. Gold's allure is not confined to investment portfolios. It's a key component in jewelry, making up about half of the gold demand worldwide. When consumer demand for gold jewelry rises, perhaps due to cultural events or fashion trends, it can put upward pressure on gold prices. Beyond the sparkle, gold is also valued for its practical uses in various industries. For instance, its high conductivity and resistance to tarnish make it crucial in electronics, dentistry, and even aerospace. Just as with jewelry, when the industrial demand for gold increases, so does its price. Conversely, a decrease in either jewelry or industrial demand can lead to a drop in gold prices. In summary, gold's practical uses in jewelry and industry create a significant portion of its demand. Hence, changes in these sectors can significantly affect the price of gold. Now let's turn our attention to the role of government reserves and policies. Central banks and governments across the globe hold significant reserves of gold. These reserves are not just symbols of wealth and power, but they also play a crucial role in the global gold market. When a government decides to make large purchases or sales of gold, it can have a substantial impact on the supply and demand dynamics. For instance, if a government decides to sell a large portion of its gold reserves, it essentially increases the supply of gold in the market, which could potentially lead to a decrease in gold prices. On the other hand, if a government or central bank decides to increase its gold reserves by making large purchases, it drives up the demand for gold, which may consequently push up the prices. Therefore, governmental actions can lead to significant fluctuations in gold prices. Market liquidity and trading volume are other important factors. Let's delve into the mechanics. Market liquidity refers to the ease with which an asset, in this case gold, can be bought or sold without causing significant price changes. A liquid market has many buyers and sellers and high levels of trading activity. The higher the trading volume, the more liquid the market. Now, why does this matter? Well, in a highly liquid market, prices tend to be more stable. There are enough transactions happening that a single large buy-or-sell order won't significantly move the market. Conversely, in less liquid markets, prices can be more volatile. A large order could potentially cause a significant price swing. This is why the liquidity of the gold market and trading volume can affect prices. It's about the balance of supply and demand and the stability it brings. So, higher liquidity and trading volume generally lead to more stable prices. Another factor to consider is the flow of gold ETFs. Exchange-traded funds, commonly known as ETFs, have become a popular way for investors to gain exposure to gold. These funds are designed to track the price of gold, and they allow investors to buy and sell shares that represent a portion of gold assets. When more investors are bullish on gold and start buying into these ETFs, it can increase the demand for gold, which in turn can push up the price. Conversely, when investors are bearish and start selling their ETF shares, it can lead to a decrease in demand and a potential drop in gold prices. The flows of funds into and out of gold ETFs can serve as a barometer for investor sentiment towards gold. As such, the popularity of gold ETFs can significantly influence gold prices. Now let's discuss how the strength of the US dollar can influence gold prices. You see, gold is priced in US dollars on the global market. This relationship means that shifts in the value of the dollar can have a significant impact on gold prices. Let's break it down. When the US dollar strengthens compared to other currencies, it essentially means you need fewer dollars to buy the same amount of gold. This can lead to lower gold prices because gold becomes less expensive in dollar terms. Conversely, when the dollar weakens, you need more dollars to buy the same amount of gold. This increased cost can lead to higher gold prices. It's a seesaw relationship. When one rises, the other tends to fall, and vice versa. This dynamic is just another example of the intricate web of factors that can influence the price of gold. Therefore, the strength of the dollar plays a major role in determining gold prices. Geopolitical events also have a significant impact on gold prices. Let's take a moment to delve into this. Picture this. The world stage is often rocked by conflicts, trade tensions, or political instability. These events can create a ripple of uncertainty in financial markets worldwide. In these times of instability, investors often seek refuge in assets that they perceive as stable and reliable. And gold, with its enduring value and tangible nature, often becomes the go-to safe haven. The rush towards gold during these periods of geopolitical stress leads to increased demand. And as we know from the basic principles of economics, when demand increases and supply remains constant, prices rise. This is how geopolitical events, from trade wars to political upheavals, can cause significant fluctuations in the price of gold. So, geopolitical events can create major shifts in gold prices, making it a crucial factor to keep an eye on when studying the gold market. Interest rates and opportunity cost are other crucial factors. When we talk about opportunity cost, we're referring to the potential benefits an investor misses out on when choosing one alternative over another. Now, let's tie this into gold and interest rates. When interest rates rise, the allure of holding gold, which doesn't offer an interest rate return, tends to decrease. Why is that? Well, higher interest rates mean you can earn more from interest-bearing assets like savings accounts or bonds. So, the opportunity cost of holding gold, which doesn't pay interest, increases. This shift can potentially lead to a decrease in demand for gold. And when demand decreases, prices typically follow suit. It's a fundamental principle of economics. Lower demand often leads to lower prices. So, in a nutshell, when you're looking at gold prices, keep an eye on those interest rates. Hence, interest rates play a key role in the fluctuation of gold prices. Let's now look at how market speculation and sentiment can influence gold prices. Investor sentiment is like the heart of the market, throbbing and pulsating with every piece of news, rumor, or perception. And speculation? It's the adrenaline that keeps the heart racing. Together, they can drive short-term fluctuations in the price of gold. Imagine this. An influential investor makes a bullish prediction about gold on a popular financial news channel. This can sway sentiment positively and encourage other investors to buy gold, thus driving up its price. Conversely, a bearish comment on a financial blog could cause a flurry of panic selling, pushing the price down. Such sentiment-driven price movements can be rapid and significant, but they can also reverse just as quickly if sentiment changes. So, while they offer opportunities for profit, they also carry risks. Therefore, market speculation and sentiment can result in rapid price movements. Lastly, let's discuss how macroeconomic trends can influence gold prices. You see, the broader macroeconomic landscape plays a crucial role in shaping investor confidence. Key indicators of economic health such as economic growth, unemployment rates, and overall market conditions can sway investor sentiment and, in turn, impact the price of gold. For instance, during periods of economic expansion, investors may feel confident to take on more risk, potentially diverting funds away from safe haven assets like gold. Conversely, in times of economic downturn or high unemployment, investors may seek the relative safety of gold, pushing up demand and consequently, its price. Moreover, overall market conditions, such as the performance of stock markets and real estate, are also significant. If these markets are performing well, gold might seem less attractive. But if they're in a slump, gold often shines brighter in the eyes of investors, so macroeconomic trends can significantly affect the price of gold. To sum up, these are the top 10 factors that influence gold prices. The cost of mining, shifts in jewelry and industrial demand, government reserves and policies, market liquidity, and trading volume all play crucial roles. The popularity of gold exchange-traded funds, the strength of the US dollar, geopolitical events, interest rates, and the opportunity cost of holding gold versus interest-bearing assets are equally significant. Investor sentiment, market speculation, and broader macroeconomic trends round out the list. Each of these elements interplays in complex ways to create the dynamics of gold prices. They offer insights for those who wish to navigate the intriguing world of gold investments. Understanding these factors is essential for anyone looking to analyze or invest in gold. And as always, if you enjoyed this video, consider subscribing for more. Your support means the world to us.